APMEX, the largest retail precious metals dealer in the United States, just told their wholesale suppliers they can't take delivery on $47 million in silver orders. Not because they don't have buyers, not because they don't want the metal, because their credit lines are maxed out and their banks won't extend more capital. This is the credit wall, and 3 of the 5 largest silver dealers in North America just hit it simultaneously. Let me show you what's happening. Let me show you why dealers who normally carry hundreds of millions in inventory are suddenly unable to finance even modest purchases. And let me show you what this liquidity crisis reveals about the silver market structure that's about to break. Silver dealers operate on credit. They don't buy metal with cash and wait to sell it. They buy on credit, sell quickly, pay back the credit line, and repeat. A dealer might have a $50 million credit facility from their bank. They use that $50 million to buy silver from refineries or wholesalers, sell it to retail customers within days or weeks, collect payment, repay the credit line, and the cycle continues. This model works perfectly when prices are stable and turnover is fast. But it breaks when 2 things happen simultaneously. Prices become volatile and physical delivery timelines extend. The first sign appeared in March. SD Bullion, a major online dealer, started showing unusual delays. Normally, they ship orders within 3 to 5 business days. Suddenly, orders were taking 3 to 4 weeks. The delay wasn't processing time. It was inventory acquisition time. They were selling silver they didn't have yet, waiting to source it, then shipping when it arrived. This is a dangerous game. If you sell silver at $24, promise delivery in 4 weeks, but silver moves to $28 before you can source the metal, you're facing a $4 per ounce loss on every sale. Multiply that by hundreds of thousands of ounces, and you're looking at millions in losses. But dealers kept playing because they assumed they could source metal. They had relationships with wholesalers, refineries, and banks. Credit was available. Physical was available. By May, the credit situation had deteriorated. JM Bullion, another major dealer, reduced their product offerings by 43%. They weren't offering less because demand was low. They were offering less because they couldn't finance inventory on products that weren't turning quickly enough. If Silver Eagles were selling within hours of listing, they'd finance those. But if a specific bar or round was sitting for weeks, they couldn't tie up credit in slow-moving inventory. The problem is that credit lines are calculated based on inventory turnover and collateral value. A dealer with a $50 million credit line might see that reduced to $35 million if their average inventory holding period extends from 7 days to 21 days. The bank's risk increases when inventory sits longer. This creates a vicious cycle. Reduced credit means less inventory. Less inventory means fewer products available. Fewer products means customers have to wait longer or buy alternatives. Longer delivery times means slower turnover. Slower turnover means banks reduce credit further. The cycle accelerates downward. By June, we started seeing something unprecedented. Multiple dealers simultaneously suspended certain product categories entirely. American Silver Eagles, normally the highest volume retail product, became unavailable from major dealers for days at a time. Not sold out, unavailable. The dealers couldn't finance the purchase of inventory they knew would sell immediately. Here's what that means. Imagine a dealer knows they can sell 10,000 Silver Eagles today at $3 premium over spot. That's $30,000 in gross margin. Easy money. But to acquire those 10,000 Eagles, they need approximately $250,000 in capital for a few days until customers pay and the cycle completes. If their credit line is already at capacity, they can't make that purchase, even though it's profitable and demand exists. This is the credit wall. Not a shortage of metal, not a shortage of buyers, a shortage of capital to facilitate transactions between sellers and buyers. The silver exists, the buyers exist, but the financing to connect them doesn't exist. The situation reached crisis level in early July. Multiple dealers reported that their primary lenders, the banks that provide their credit facilities, were demanding higher collateral requirements. Previously, a dealer might get $1 of credit for every dollar of silver inventory. Now banks were requiring $1.30 of collateral for every dollar of credit. Some banks moved to 1.50 to 1. This collateral requirement increase effectively reduces available credit by 23 to 33% overnight. A dealer with a $50 million line now only has access to 33 to 38 million because they need to post more collateral against the same credit. Why are banks increasing collateral requirements? Because silver price volatility has increased. When silver was trading in a tight $23 to $26 range, banks could calculate risk easily. But when silver starts moving $2 to $3 in a day, banks get nervous. They see scenarios where the dealer's inventory loses value before it can be sold, leaving the bank with under-collateralized loans. The banks are also concerned about the dealer's counterparty risk. Dealers buy from wholesalers and refineries on credit terms. Net 30 or net 45 payment terms are common. The dealer receives metal today and pays in 30 to 45 days. But if the dealer's credit is stressed and they can't pay, the wholesaler faces losses. Banks see this counterparty web and realize that stress at one dealer could cascade to wholesalers, refineries, and other dealers. Here's the specific example that's circulating in the industry. A major dealer, name withheld but confirmed through multiple sources, placed an order for $8 million in silver products from a refinery. The refinery shipped on standard payment terms, expecting payment in 30 days. But the dealer's credit line was maxed out. They couldn't pay. The refinery is now in a legal dispute trying to recover the metal or payment. The dealer's bank, seeing this situation, froze the credit line entirely, pending resolution. That dealer is now effectively out of business. They can't buy new inventory. They can't fulfill customer orders. They're liquidating existing inventory to pay down debt and close operations. This is a business that did over $300 million in annual sales. Gone because credit dried up. But it's not just one dealer. Industry estimates suggest that 4 to 6 major dealers are currently operating at or above 95% of their credit capacity. They're one bad price move away from being unable to finance operations. The liquidity problem isn't limited to retail dealers. It's affecting the entire supply chain. Wholesalers who sell to dealers are facing their own credit constraints. They source metal from refiners, sell to dealers, and collect payment when dealers sell to customers. But if dealers are taking longer to sell and longer to pay, wholesalers need more credit to bridge the gap. Several wholesalers have responded by tightening credit terms to dealers. Instead of net 30, they're demanding net 15 or even cash on delivery. This puts additional pressure on dealer credit lines because now dealers need to pay faster while their own customers are taking the same time to pay. Refineries are also feeling pressure. They need to buy raw material, pay for refining, and deliver finished product before receiving payment. If their payment cycles extend because wholesalers are slower to pay, refineries need more working capital. Some refineries have reduced production specifically because they can't finance increased output, even when demand exists. This is a liquidity crisis cascade through the entire supply chain. Raw material suppliers, refineries, wholesalers, dealers, everyone needs more credit simultaneously. But banks are providing less credit because they see increased risk. The data supports this. Precious metals dealer financing, as reported to banking regulators, has declined by 18% in the second quarter compared to first quarter. This is the largest quarterly decline since the 2020 COVID crisis, when banks pulled back on all commodity financing. But this decline is more concerning than 2020. In 2020, the pullback was across all commodities due to general economic uncertainty. Banks reduced credit everywhere. This time, the pullback is specifically concentrated in precious metals financing. Banks are still financing other commodities. They're choosing to reduce silver financing specifically. Why? Because banks are the same institutions with massive silver derivative exposure that we've discussed in other videos. They see the same data we see. They know the market is tight. They know prices are volatile. They know defaults could cascade. They're reducing credit to dealers as part of broader de-risking from silver exposure. This creates an impossible situation. Banks won't finance dealer inventory because they fear silver market disruption. But reducing dealer financing causes the very disruption they fear. Dealers can't acquire inventory. Physical shortages worsen. Premiums spike. Prices become more volatile. The bank's worst-case scenarios are being triggered by their own defensive actions. The impact on retail investors is immediate and severe. Premium costs have exploded. 6 months ago, you could buy Silver Eagles for $2.50 to $3 over spot. Today, when dealers have inventory, premiums are $6 to $8 over spot. That's not because dealers are greedy. It's because financing costs have increased and dealers need higher margins to justify the capital requirements. Delivery times have extended dramatically. Orders that used to ship in a week are now taking 4 to 6 weeks. Some dealers are being upfront about this. Others are still advertising ships in 5 to 7 business days, but then sending delay emails weeks later. The delays are real, and they're caused by financing constraints that prevent dealers from maintaining normal inventory levels. Product availability has collapsed. Visit any major dealer website. Count how many products show out of stock or notify me when available. 6 months ago, 90% of products were in stock. Now it's closer to 60%. The missing 40% isn't sold out because of overwhelming demand. It's not listed because dealers can't finance the inventory to offer it. This has created a two-tier market. If you're willing to pay high premiums and wait weeks for delivery, you can buy silver. But if you want immediate delivery at reasonable premiums, the market barely functions. The dealers who could previously provide that service can't do it anymore because their credit is constrained. We're also seeing dealers exit the market entirely. At least 3 significant dealers have ceased operations in the past 60 days, not because they were unprofitable, because their credit was pulled. Banks decided the risk wasn't worth the relationship and terminated credit facilities. Without credit, dealers can't operate. They liquidate and close. The remaining dealers are consolidating around the largest players with the strongest balance sheets. APMEX, JM Bullion, SD Bullion. The majors with substantial capital bases and diversified banking relationships are capturing market share. But even these giants are constrained. They're growing market share but can't grow absolute volume because credit limits prevent it. This consolidation is dangerous. When 3 dealers control 70% of retail volume and all 3 are operating near their credit limits, the market is one crisis away from complete breakdown. If one of the majors faces a credit freeze, like the dealer mentioned earlier, 40% of retail silver supply could disappear overnight. The banks know this. The dealers know this. The wholesalers know this. Everyone in the industry knows the system is operating on the edge of functional capacity. They're trying to manage it quietly, hoping liquidity improves, hoping volatility decreases, hoping the credit wall doesn't trigger a broader crisis. But credit walls don't get better during volatile markets. They get worse. And silver is about to get more volatile, not less. Industrial demand is accelerating. Investment demand is increasing. Central banks are accumulating. Supply is constrained. All the factors that would normally cause dealers to increase inventory and ramp up operations are present, except the one thing they need most: capital to finance it. The credit wall has been hit. Major dealers are at capacity. Liquidity is drying up. And the silver market that retail investors depend on for access to physical metal is running on fumes. When the credit finally runs out entirely, when the wall can't be managed anymore, The disconnect between paper silver prices and physical availability won't be a premium. It'll be a total market failure where physical simply isn't available at any price through normal channels. The silver exists, the buyers exist, but the financial system that connects them is breaking. And when it breaks completely, the price discovery mechanism that we think determines silver's value will prove to be a fiction built on credit that no longer exists.